Hello, my name is David and I'm here with Erica and Ibrahim. So today we present on the Tsingshan's Holding Group US $8 billion nickel trading loss in 2022, one of the biggest derivative mishaps in recent history. First off, I would like to start off the summary. Tsingshan is the world's largest stainless steel and nickel producer. In 2022, it took a massive short position in nickel futures, expecting prices to fall. But when Russia invaded Ukraine, fears of sanctions caused nickel prices to triple within days. As a result, Tsingshan faced paper losses of $8 million USD. The London Metal Exchange suspended nickel trading and even cancelled trades, which many investors criticized as unfair. Overall, the crisis damaged Tsingshan's reputation and reduced confidence in the nickel market. Moving on to introduction, this case is important because it shows how derivatives like future contracts can be both protective and dangerous. Tsingshan used nickel future to hedge its exposure, but the sheer size of the bet and unexpected geopolitical shock turned the hedge into a huge loss. The case highlights why proper risk management and strong oversights are essential. So what happened and the consequences? Specifically, Tsingshan shorted between 100,000 and 300,000 tons of nickel futures. When nickel prices surged above USD 100,000 per ton, the company faced massive margin calls and had to secure emergency loans from JP Morgan and other Chinese banks. The LME halted trading and cancelled trades to prevent a wider collapse. For Tsingshan, the consequences were severe. It recorded billions in losses. Its reputation was also damaged, and investor confidence in nickel markets was also shaken. So this Tsingshan case shows how quickly a hedge can turn into a crisis and why company must prepare for extreme scenarios in risk management. Thank you.
Next, I'll be talking about the type of derivative products used and how they exacerbated the risk. Tsingshan's strategy was simple. They entered into short futures contracts. This means they sold nickel at a high price, betting the price would fall. They plan to buy it back later at a lower price, pocketing the difference, and it's a common hedge unless you get the bet wrong. But three critical risks converged. First and most crucially, geopolitical risks. Tsingshan failed to account for the Ukraine war and they assumed that they could source cheap nickel from Russia to cover their positions. But with potential sanctions and market chaos, that supply line was suddenly in jeopardy. Second would be competition risks. Other companies seeing Tsingshan's vulnerable position likely piled in buying nickel and driving the price up further, squeezing the short seller. And lastly, delivery risks. Global conflict caused logistical nightmares, making it impossible for anyone to deliver metal on time. The market supply of nickel then tightened sharply. As a result, nickel prices exploded overnight. Tsingshan's short position, a staggering 200,000 tons, was now underwater. Their account swung to a negative $12 billion and they faced margin calls they couldn't meet, meaning potential bankruptcy and a systemic collapse of the nickel market. So why did risk management fail so completely? The failure was twofold. Firstly was exchange failure. The LME lacked vision and they allowed Tsingshan to build a short position roughly 5 times the size of their available nickel inventory. This was a colossal concentration risk that they failed to foresee. Then when the crisis hit, they halted trading and cancelled all trades made on March 8th. This destroyed market trust, protecting Tsingshan by undermining the very principle of a free market. Secondly would be internal failure. Tsingshan's own risk management was reckless and no company should ever amass a position so large it can break the entire market. They bet the company on a single outcome and ignored glaring warning signs. In the end, the Tsingshan squeeze was a perfect storm, a corporate gamble of epic proportions met with a black swan geopolitical event and overseen by an exchange that was asleep at the wheel.
Hello, my name is Ibrahim. From the Tsingshan nickel crisis, we can draw four key lessons. First, hedging versus speculation. Their futures position were meant as a hedge, but their sheer scale turned it into speculation, showing how oversized hedges can create risk instead of reducing it. Second, liquidity management. Tsingshan was solvent but nearly failed because it couldn't meet margin calls. This highlights the need for strong liquidity buffers and diversified credit sources. Third, transparency and market integrity. Their opaque OTC trades created systemic blind spots, and the LME's cancellation of trades undermined trust. Greater disclosure and better oversights are crucial. Finally, ethics and reputation. Beyond financial losses, Tsingshan suffered reputational damage. Effective risk management must also include ethical responsibility and protecting market trust. In short, we learned that this case shows that risk management is not just financial, it is also about transparency, liquidity, and ethics. Moving on, if I were in a senior role managing the company's risk, my approach would have been very different. First, I would enforce strict position limits, ensuring future contracts only match actual production capacity. This prevents hedges from spiraling into speculative bets. Second, liquidity readiness. I would build strong liquidity buffers and diversify funding sources. This way, sudden margin calls would be met without destabilizing the firm. Third, transparency. I would require full disclosure of large exposures, both exchange-traded and OTC. This is crucial to prevent blind spots and avoid the kind of reputational fallout we saw after the 12 billion trade cancellation. Finally, ethics and governance. Risk management should not only protect profits, but also stakeholders' trust. Decisions must be guided by fairness, responsibility, and transparency. On a personal level, I may accept higher risks since it's only my own capital. But in a corporation, I believe risk management must be conservative, ethical, and focus on safeguarding wider stakeholders. In closing, the Tsingshan nickel crisis showed us that risk management is not just about numbers, it is about discipline, transparency, and ethics. Without these, financial stability and market trust can collapse overnight. The key lesson is clear: safeguarding stakeholders and market integrity must come before chasing short-term profits. And with that, thank you.